Welcome to the Chrisman Commentary Daily Mortgage News Podcast. I'm your host, Robbie Chrisman. Topics on today's episode include HUD proposed changes to mortgage insurance premiums, my interview with MBA's Broeksmit, addressing a variety of current action items on MBA's docket, and is housing data really indicative of overall economic slowing? Thank you to Wholesale Mortgage Direct for sponsoring today's podcast. Their mission is to deliver high-demand, innovative products unique to the wholesale industry, including My EQ Now, which is a one-of-a-kind traditional HELOC platform. Looking for innovative HELOC, non-QM, and or reverse options? WMD is your trusted partner. With possible ramifications for the single-family business, perhaps the big news for lenders in general recently was the U.S. Department of Housing and Urban Development, or HUD, proposing changes to the mortgage insurance premiums for FHA multifamily insurance programs. This proposal aims to address current economic challenges and stimulate the development of rental housing across the country. Recall that in 2016, HUD reduced mortgage insurance premiums for loans under three categories: green and energy-efficient housing, affordable housing, and broadly affordable housing. However, market rate properties were left with significantly higher mortgage insurance premium rates. Earlier this year, President Trump signed a presidential memorandum titled Delivering Emergency Price Relief for American Families and Defeating the Cost of Living Crisis, which prompted HUD to propose reduced mortgage insurance premium rates for all loans under the FHA multifamily mortgage insurance program. Over the past couple of years, rising construction costs and elevated borrowing rates have led to a decline in market rate property loans. The proposed expansion of mortgage insurance premium cost savings to all property types aims to lower financing costs and encourage rental housing and development. High mortgage insurance premiums have traditionally been a disadvantage for loans under these programs, and the proposed decrease seeks to provide a long-term debt solution for multifamily borrowers. HUD's proposal includes a uniform upfront capitalized mortgage insurance premium of 25 basis points for all FHA multifamily mortgage insurance programs, replacing the current range of 25 to 100 basis points. Additionally, the annual mortgage insurance premium would be reduced to 25 basis points from the current range of 25 to 95 basis points. This uniform rate would eliminate the 2016 loan categories, including green and energy-efficient housing, affordable and broadly affordable, as they will be considered economically obsolete. The specialized requirements outlined in the 2016 rules for these categories would also be eliminated. HUD believes that these changes will simplify the cost-benefit analysis for owners, developers, and lenders, reducing complications and stimulating multifamily development by lowering overall development costs. The new mortgage insurance premium rates will apply to FHA multifamily mortgage insurance applications submitted or amended on or after the effective date of the notice, unless the loan has already been endorsed. The proposed changes are open for public comment until July 28, 2025. For today's interview, I wanted to welcome back to the show MBA's Broeksmit, President and CEO of the Mortgage Bankers Association, to talk about current action items on their docket. He's a senior finance executive and corporate officer with over 35 years of experience in the mortgage sector and has directed all aspects of lending activities, including marketing, sales, operations, secondary marketing, loan servicing, and default management. He's also served as a mortgage underwriting expert, testifying on many large, high-profile cases.
Big initiatives that are on your desk right now? Can you kind of run, we don't have to go into depth necessarily, but run through a couple big action items for you and MBA currently?
Well, sure. Kind of a standing agenda item, Robbie, because perhaps the likelihood is low, but the weight of it is so high is GSE release. And I could spend the rest of the show boring our listeners about that. And I would say that it's simmering as opposed to on the boil, but always on our minds. And credit reports, of course, have been a significant issue the past 2 or 3 years, but that's come straight to the front burner with the VantageScore announcement. Happy to talk more about that. And while there's not necessarily anything that we as a trade association can do about it, of course, we're closely following consolidation and member profitability and effects that could have on the competitive landscape in our industry.
Well, I will get to those eventually, because I know people definitely want to hear about them. The next one in this line of questioning is, how do you weigh success? I don't know if you look back quarterly, semi-annually, annually, at the end of the accounting calendar for MBA. I don't know what it is, but how do you say this was a good year? Or
Yeah.
is it in issue by issue, or on aggregate? How do you
Yeah, it's a great question because it's something that we grapple with. We are so forward focused that the minute we get a win, we're on to the next thing. And I'm told by people who don't live and breathe this every day the way we do at MBA, that if you don't say it a lot of times, it doesn't register. And so when you come to the end of our fiscal year, happens to be October 1 to September 30, when you come to the end of the year and you weigh things and say, well, good year, bad year, in between year, and then you go back and look at everything you got done and say, wait a minute, boy, that was actually quite a lot. So there are some very obvious ones. I'll give you a recent example. The Congress just passed, and we're told the president has now signed a bill allowing the partial claim loss mitigation option for VA loans. And that was an MBA initiative for when the pandemic emergency ended and VA took away the partial claim option. Whereas you guys know, if you fall on hard times and miss some mortgage payments, you can resume making your payments, but put the missed payments on the back, which of course is the forbearance lesson we learned during the pandemic. And every other government related loan has made that a permanent part of its loss mitigation waterfall. FHA, VA, USDA, Fannie, FHA, USDA, Fannie and Freddie, but VA had not. So they stopped giving the option. In this country, we're used to giving our veterans at least as good or often better consideration than everyone else. And here's a case where they were getting treated more poorly than any other government-related borrower. So anyway, to make a long story short, we worked with the House Veterans Affairs Committee, got the legislation written, got it perfected, got it passed, and then went from a standing start in the Senate where they hadn't even thought about it to getting a bill passed just last week. I mean, that's a win with a capital W and an exclamation point at the end. So those are really easy to track. And then there are other things where often our job is to prevent bad things from happening. So it's a little harder to blow our horn about those, but they're equally important, sometimes more important to the industry. And for an example of that, I'll point you to the big, beautiful bill where we knew, of course, everyone knew that the Tax Cut and Jobs Act of 2017, the Trump tax cut, was going to expire at the end of 2025. So we knew this would be a monumental year in tax policy. And anytime you talk about tax, you also talk about revenue because they need pay-fors for the tax cuts. So we convened a board-level tax task force. We identified all the issues that mattered, especially to our industry, and we either led on certain issues that were mortgage specific, or we worked in coalition with other financial services trades on broader financial services related matters, and had an absolute home run of what was not done in the tax bill. So the mortgage interest deduction was not lowered. In fact, it was made permanent, and mortgage insurance premiums are now deductible again. And Section 199A, which keeps the tax rate for S corps and partnerships, which is what most of our members are, in parity with C Corp. And you go on and down the list: 1031 exchanges, more money for LIHTC, opportunity zones. And it was just a really great outcome for MBA. So there's a lot of different ways to measure, some very obvious and some a little more nuanced.
So I was at MBA Advocacy, Bob, which I really enjoyed. That was my first time going there. Scott Turner from HUD came, Elizabeth Warren came. That's funny. Scott's saying we're doing great things. He fires the crowd up. Elizabeth comes in and says, Trump's ruining everybody's life, blah, that sort of thing. I then went, the next day you go to Capitol Hill, you meet with your senator, representative, or their staff members, and everybody goes, yeah, housing affordability, bipartisan issue. We'd love to get things done. We'd love to get it done. A little harder in practice to get something signed on the president's desk. And I'm wondering lessons that you've learned in dealing with politicians. And that ties into the last question about success, because it might seem like you're doing, politicians are on your page or you're going to get something done, and it doesn't. But maybe you've made inroads. Like what you've learned in DC about schmoozing properly and getting things across the finish line. I'd love some insight.
Sure. I think some great examples of this a year ago now when we were at both conventions. We were at the Democratic convention in Chicago after we were at the Republican convention in Milwaukee. And that's a target-rich environment. You had pretty much every senator and a lot of the House there, along with all kinds of people representing both administrations. And the thing that I find the most effective, because you're right that housing is bipartisan. So you've got something in common with everybody you're talking to. There's nobody who doesn't care about housing. But the most effective thing I've found is to know a little bit about the person you're talking to and have the first question or interaction be on something they know and care deeply about. And that differs by representative. It might be specific to their state. It might be specific to a committee they chair. And I'll give you an example of a senator in Delaware who was very involved in and interested in county level government, because that's the way he'd come up his electoral career, and in getting hard to build affordable communities done. And so by engaging on that topic, it had nothing to do with the Senate or federal policy, but Newcastle County, Delaware, and also knowing that he chairs the committee that funds the State Department, so a big international component. You talk a little bit about that, and then you say, why won't you sign on to the trigger leads bill, or, whatever it is, as opposed to just being exactly like everyone else who comes up to them and goes straight into their issue. And you do run the risk of running out of time because they're not going to give you 20 minutes. But if you draw them in and you make a human connection, and then you quickly pivot, because again, they could get pulled away at any time. I found that the most effective. And I'll give you kind of an inside Washington story. In the past 10 days, I have, in an unscheduled way, seen 3 senators. And every time after the, connection, I say, boy, we're almost to the finish line with this trigger leads bill. What can we do to get it over the finish line? And I'm really optimistic that we're within a hair's breadth of that happening. As you know, it keeps passing without any opposition, the houses, but we haven't had an identical version pass both houses, which is the requirement. So the Senate has to pass it one more time. But just those unscripted, unscheduled things with people that I've met and can say something. I mean, in some cases, they know me and recognize me. Other cases, it's, oh, enjoyed spending time with you in Milwaukee, or, whatever it is. And then get to that seems to be paying some dividends.
Well, I do want to give you plaudits here, because one of the things that's commonly heard is that Bob is great at kind of these, pardon the term here, but rubbing elbows in the back rooms of DC, of the country clubs of DC. That's where you make your mark. How do we get MBA more a seat at the table, or like not feared, but what MBA, a more powerful voice in DC? And I'm beating around the bush a little bit. Maybe a more cynical way of saying that would be, we should have more power in DC, which is obviously easier said than done. How do we get to the point where people feel like MBA is really throwing its weight around in a way that's commensurate with the overall mortgage industry and how it affects the overall economy?
Yeah, I mean, I think this may have something to do with what we were talking about earlier, where we check one thing off the list and we go to the next, as opposed to spending a whole lot of time blowing our own horn. I think there may be a gap between the perception that you're articulating and the facts on the ground, because we really are at the center of all these discussions. And I guess I would also say that I think you need to temper the expectations of, I think maybe as a practitioner would say, well, something's going on that doesn't make sense in Washington, and we ought to be able to fix it immediately. And there are, it is difficult to get Washington to bend to your will with so many things going on that have such consequence. While something may be the number one thing in our industry, it is sometimes difficult to get it to the top of people's lists in Washington to fix. And that's, I think, more true than ever with the hyper-partisan nature of things in DC. But so something, for instance, that's probably not been much reported on is about a month ago today, we had our leadership spend an hour with Mike Johnson, the Speaker of the House, and French Hill, the head of the House Financial Services Committee, and other key elected representatives talking about nothing but our issues. And MORPAC has a significant role to play there. And that money is the mother's milk of politics. And I think we do a really good job with it. And we found ways to step up and do better. And I think that continuing to do that will increase our exposure and our effectiveness in DC.
The U.S. economy is driven by jobs and housing, and we're starting to see undeniable signs of a slowing economy in the latter. June housing data came in weaker than expected, with both new and existing home sales underperforming, signaling continued sluggishness in the housing market. While new single-family home sales rose slightly to 627,000, they missed forecasts, and the median new home price dropped 2.9% year over year to 402,000, the second lowest level since September 2021. Inventory climbed sharply, with new home listings reaching their highest since 2007 and existing listings hitting a post-2020 high, pushing months' supply near 2022 levels when prices briefly declined. Despite these headwinds, softer shelter inflation is helping temper broader price pressures and may partially offset the inflationary impact of new tariffs in the second half of 2025, though housing remains a downside risk to GDP growth. The outlook for a slow decline in yields is supported by easing inflation and prospects of rate cuts, although longer-dated maturities like the 30-year are likely to underperform due to sticky inflation expectations and term premium. The case for significantly higher 10-year Treasury yields has weakened along with the economy as markets have largely priced in peak impact of trade war tensions and debt supply stress without pushing yields above 4 5/8%. The current environment suggests a prolonged period of range-bound trading, possibly between 4.10% and 4.65%, before Fed rate cuts eventually pressure that yield to below 4%. And don't forget about persistent Treasury supply concerns, expectations of a higher long-run neutral rate, and the likelihood of policy normalization under a new Fed chair. Markets anticipate Powell will gradually lower Fed funds rates toward 3.25% before his term ends, supporting a base case of easing inflation pressures without triggering a deep downturn or renewed inflation. In the short term, with the FOMC expected to hold steady and Powell likely to maintain a cautious tone, attention is turning to the Treasury refunding announcement, where a potential increase in buybacks could boost demand for long-duration debt. Mortgage rates are expected to end 2025 and 2026 at 6.4% and 6.0% respectively, downward revisions compared with last month's forecast of 6.5% and 6.1%, according to the July 2025 Economic and Housing Outlook from the Fannie Mae Economic and Strategic Research Group. The group also updated its home price growth forecast this month and now projects annual home price growth on a Q4 to Q4 basis of 2.8% in 2025 and 1.1% in 2026. These are downward revisions compared with the previously projected 4.1% and 2.0%. Total home sales are forecast at 4.85 million units in 2025 and 5.35 million units in 2026. Mortgage rates fell for the first time in 3 weeks in Freddie Mac's primary mortgage market survey. For the week ending July 24th, the 30-year and 15-year mortgage rates declined 1 basis point and 5 basis points respectively to 6.74% and 5.87%, and are now just 4 basis points and 20 basis points lower from a year ago. Today's loan data point is the always volatile durable goods orders for June, and we begin the day with agency MBS prices little change from Thursday's close, the 2-year yielding 3.92 and the 10-year yielding 4.41 after closing yesterday at 4.41%. Let's wrap up with a joke and some housekeeping. Sometimes I feel like I repeat jokes, and maybe I use this one already, but I think it's hilarious. What do you call a Chinese billionaire? Cha-ching. Oh, it's all in good fun. Relax. Thanks again to Wholesale Mortgage Direct, whose mission is to deliver high-demand, innovative products unique to the wholesale industry, including My EQ Now, which is a one-of-a-kind traditional HELOC platform. WMD is your trusted partner for innovative HELOC, non-QM, and or reverse options.